This is why most people are misreading what silver just did. Silver did not fail, it did not break down, and it did not top out. What silver actually did was enter a high volatility phase, and that distinction matters more than the price itself. When people see sharp pullbacks after a strong rally, they assume the move is over. They think something must be wrong. That assumption is what gets people shaken out at exactly the wrong time. Silver is not a smooth market. It never has been. It's a small, thin market, and that means when capital rotates in, price doesn't climb in a straight, polite line. It snaps. That snapping behavior is not panic. It's not weakness. And it's usually not fundamentals suddenly changing overnight. Most of the fast drops people panic over are mechanical shakeouts. They're caused by leverage, margin pressure, and positioning that became too crowded too quickly. When volatility rises, exchanges raise margin requirements. Brokers tighten risk controls. Traders who were fine yesterday suddenly need more cash today. If they don't have it, they're forced to sell, not because they want to, but because the system demands it. That forced selling creates ugly candles. Those candles scare weak hands, and once that pressure clears, price often stabilizes or reverses just as fast as it fell. That's not silver failing. That's silver doing what it always does during momentum phases. Now here's the part most people completely miss. Even after the recent surge, silver is still cheap relative to gold. Not slightly cheap, historically cheap. That means this move is not starting from excess or euphoria. It's starting from a discount that hasn't fully corrected yet. This is important because silver doesn't usually lead precious metal cycles. Gold does. Silver lags, then catches up, and sometimes overshoots. That's been the pattern across multiple bull markets. So when people look at silver in isolation and say it's gone up too much, they're missing the context. The correct question isn't, did silver move fast? The correct question is, relative to gold, is silver actually expensive yet? And right now, the answer is no. That's why the real danger at this stage isn't silver going down. The real danger is getting shaken out before the next expansion leg. Markets do not reward comfort during regime shifts. If you're waiting for silver to calm down, to look safe, to stop being volatile, that moment usually arrives after the biggest part of the move is already behind you. That's when headlines feel reassuring. That's when consensus forms. And that's when upside becomes more limited. On the flip side, if you react emotionally to every sharp pullback, you end up selling strength and buying fear. You convince yourself you're being cautious, but in reality, you're letting volatility dictate your decisions. This is why being right on direction is not enough in markets like this. You also need position sizing you can tolerate, a time horizon that matches the thesis, and a clear understanding of what kind of market you're actually in. High volatility markets feel uncomfortable by design. They transfer assets from impatient holders to prepared ones. They reward people who understand structure, not people who react to every candle. So, the takeaway here is simple. Silver did not fail. It transitioned. And transitions are messy, noisy, and emotionally difficult. But they're also where the biggest moves tend to begin. If you're involved in silver, the goal right now isn't to predict the next dollar move. It's to avoid making decisions that remove you from the trade before the thesis plays out. Because the biggest regret in markets like this usually isn't being wrong. It's being right, but not being there when it mattered. If you found this helpful, let me know in the comments.